Welcome to Words of Stardon. This is CH. This video provides a quick first half of 2026 performance summary of the funds and ETFs I covered previously, specifically on the Sing Dollar share classes for Sing Dollar investors. Please refer to the other similar video if you are looking for a US dollar version. I will be using Morningstar charts to compare the funds in different asset class categories, looking at total return for the 6-month period. I'll also be using retail share classes for the mutual funds that are most commonly offered by local distributors. Do refer to the fund-specific videos if you are interested to find out more about any funds covered here. Some quick disclaimers before we start. In this video, we are looking at performance of the funds for 2026 start of the year till end of June. That should not be used to assume that future performance will be similar. We are also looking at only a short 6 months track record. That can be very different from the long-term average performance. Do bear this in mind. For those of you who haven't seen my usual fund-specific videos, here is a quick guide on how I normally present the Morningstar performance charts. In short, the best performing fund is the top item in the list at the right side, which is color-coded to match the lines in the chart and the ISIN or identifier plus performance number in the chart legend. Equity markets had a bit of correction in March with the commencement of the US-Israel versus Iran war, although the negative impact only lasted about a month. The strong momentum in AI thematic play, now evolved to Asia chip makers, led the global markets to new highs, and with TSMC, Samsung Electronics, and SK Hynix now comprising about 40% of CEMA. It should be noted that MSCI World had generated over 10% returns in Sing dollar terms in just the past 6 months, which is equivalent to its long-term average annual returns. Without an overweight to the Asia chip makers, active global equity funds I covered underperformed IWDA. HSBC Islamic Global Equity Index Fund, with small allocations to emerging Asia, inched out 1.2% more than IWDA. AB Low Volatility Equity was the worst performer, failing to capture enough market upside. Global income-focused equity funds, on the other hand, delivered mostly similar returns as IWDA, with lower drawdowns exhibited in February and March period. All Spring Global Equity Enhanced Income had a spike of stronger returns in June, while Fidelity Global Dividend showed some periods of increased volatility compared to the rest. I covered a few active ETFs running different US equity strategies, but they are all US dollars only. So what we have here is just a passive tracker in Sing Dollar share class from Amundi. Income-focused strategies in the US markets were mixed. Cover call strategies like Neuberger Berman US Equity Premium underperformed SPYL, but had less drawdown in March. UBS US Total Yield Sustainable Equity Fund managed to outperform from May onwards, but there are no details provided on what it did different. In the Europe equity market, Schroder European Value had bouts of outperformance that were not consistent, ending this period below IMEU in Sing dollar terms. Small caps solutions generated very different results, showing large disparities in this space. While both covered US small caps space, Roy's US Small Cap Opportunity ended the period with 19% outperformance versus T. Rowe Price US Smaller Companies. Emerging market equities had a strong run, thanks to Asia chip makers, though I only managed to cover the passive tracker from Amundi in this category. Asia equity funds were mixed. Allianz Oriental Income started the year strong, but lost its gains versus CEMA in May. FSSA Asian Equity Plus continued its underperformance from last year. CFA, representing Asia REITs, was bad and ended the period with minus 3%. YLD, representing Asia Financials, was better, but nowhere near CEMA that was boosted by the chip makers. Japan equities continue to perform relatively well compared to global developed markets. Active growth strategy seems to work better so far this year, as shown here with Lion Global Japan Growth versus Amova Japan Dividend Equity. While the Asia chip makers celebrate, India continued to be forgotten and left struggling. Singapore equity continues to do decently well, with ES3 and G3B leading the pack, showing clearly any strategies that try to deviate from the high concentration of the three local banks will suffer in performance. CLR representing S-REITs continued to underperform significantly. Infrastructure and Utilities team again showed its usefulness for defensive investors, having held up very well through the March market correction. Resources team started the year and went through the March market correction strong, but seems to be also undergoing some correction in June. Broad Healthcare team, as represented by AB International Healthcare, continue to wander aimlessly, though the subsector focus Janus Henderson Biotechnology had a strong rebound in June. Global bond markets were broadly flat for the first half of 2026, with IGLO representing global government bonds dragging down the group, offset by IEMB representing emerging market bonds and AT1 representing high-yielding financial bonds. Interest rate directions remain a key question for the rest of the year. Global diversified bond funds were highly correlated. While they all outperformed AGGG in US dollar terms, the currency hedging costs dragged down the returns in Sing dollar terms. Risk-averse investors may want to simply go with short-duration solutions to minimize interest rate risk and market volatility. HSBC Ultra Short Duration Bond has shown to be the most stable in the pack and has actually outperformed all the global diversified bond funds in the previous chart. High-yielding bonds were similarly quite flattish for the first half of the year. Preferreds and CoCo bonds delivered slightly better returns than high-yield bonds. Man Dynamic Income, with its long-short strategy, held up well during the March correction and therefore ended this period well ahead of the rest. While not entirely emerging markets focused, Templeton Global Total Return has had a pretty volatile run for this period and ended slightly below IEMB, partly due to Sing dollar currency hedging costs. Asia bond markets were slightly better than global bonds but weaker than emerging market bonds. BlackRock Asian Tiger Bond lost its early gains in March and underperformed ASIG. First Sentier Asia Quality Bond clearly lagged behind even more. Sing dollar focused bond solutions delivered better returns than ASIG, especially in Q2, and outperformed global diversified bond funds as well. Eastspring Singapore Select Bond moved nicely in between A35 and MBH, capturing a mix of government and corporate bonds. The Sing dollar focused short duration bond funds were generally stable, though underperforming ASIG in Sing dollar unhedged terms. Of the Sing dollar liquidity funds I covered, Lion Global Sing dollar Money Market continued to inch out slightly higher returns than the rest. Many multi-asset funds do not set a benchmark or performance target, claiming their portfolios are dynamic and therefore have no suitable benchmarks. I find this quite rubbish, as I believe investors need to compare the funds with a benchmark to figure out if the funds are doing good or bad. An easy way is to use, for example, IWDA and AGGG to create a mix of broad equity versus bond asset allocations, where then we can compare the performance against the funds. However, IWDA and AGGG do not have Sing dollar share classes. Another way is to use the range of fixed allocation multi-asset funds from Dimensional that covers an even broader universe through a quantitative approach, and comes with Sing dollar share classes as well. Most global multi-asset funds tend to have an asset allocation mix in between 60 equities, 40 bonds, and vice versa. In the first half of the year, Manulife Global Multi-Asset Diversified Income clearly was a laggard, while Lion Global All Seasons Growth, PIMCO Balanced Income and Growth, and Aberdeen Income Plus led the pack. This chart also gives an idea on how aggressive or defensive are the asset allocations of each fund. US multi-asset funds also delivered a wide range of returns. Franklin Income had the lowest drawdown in March, but did not capture enough market upside thereafter. Capital Group American Balance lead the pack, while Janus Henderson Balance was a clear laggard. For Asia multi-asset, Schroder Asia More Plus as the only covered fund delivered decent returns and well above global and US multi-asset solutions. That's all for the first half of 2026 performance summary video for Sing Dollar investors. Thanks for watching till the end, and I hope this video and my channel will help in your investment journey. May we all grow wiser and prosper.